Imagine you just got a raise at work. Congratulations. You're feeling happy and proud of yourself. But then you wonder, how will this affect your taxes? Will you end up paying more than you earn? How does the government decide how much to take from your paycheck? These are common questions that many people have, but few people know the answers to. That's why in this video, I'm going to demystify the concept of tax brackets and show you how they work in the U.S. tax system. By the end of this video, you'll have a clear understanding of how much tax you pay and why, and you'll be able to plan your finances better. So stay tuned and let's get started. What if I told you that you don't pay the same tax rate on every dollar you earn? That's right. The U.S. tax system is not as simple as you might think. In fact, it's based on a concept called tax brackets, which are like steps on a ladder. As you climb up the ladder of income, you pay a higher tax rate on each step, but only on the income that falls within that step. This means that your tax rate changes depending on how much you earn, but not in the way you might expect. In this video, I'm going to clear up a common misconception about tax brackets and show you how they work in practice. You'll be surprised by how much tax you actually pay and why. So, let's get started. In this video, we are going to learn about tax brackets and how they affect your income tax. Tax brackets are ranges of income that correspond to a certain percentage of tax. The U.S. tax system has 7 tax brackets for single filers in 2023, and they are shown in this table. This means that if your income is up to $9,950, you pay 10% of your income in taxes. If your income is between $9,951 and $40,525, you pay 12% of your income in taxes. If your income is between $40,526 and $86,375, you pay 22% of your income in taxes, and so on until the highest bracket, which is 37% for income above $523,600. But wait, there is a catch. You don't pay the same tax rate on every dollar you earn. You only pay the tax rate for the income that falls within each bracket. For example, if your income is $50,000, you don't pay 22% of your entire income because $50,000 falls within the 22% bracket. Instead, you pay 10% of the first $9,950, 12% of the next $30,575, and 22% of the remaining $9,475. This way, you pay less tax than you would if you paid 22% of everything you earn. These brackets are not fixed, but change every year based on inflation and other factors. They also depend on your filing status, such as single, married, or head of household. Now you might be wondering, what does this table mean? How do I use it to calculate my tax? Well, it's actually quite simple. All you have to do is follow these steps. First, find your total income for the year. This is the amount of money you earned from all sources, such as wages, salaries, tips, interest, dividends, capital gains, etc. You can find this information on your W-2 form, 1099 form, or other tax documents. Second, subtract any deductions from your total income. Deductions are expenses that you can subtract from your income to reduce your taxable income. Some common deductions are the standard deduction, which is a fixed amount that everyone can claim, or the itemized deduction, which is a list of specific expenses that you can claim, such as mortgage interest, charitable donations, medical expenses, etc. You can choose either the standard deduction or the itemized deduction, whichever is higher for you. You can find more information about deductions on the IRS website or consult a tax professional. Third, find your taxable income. This is the amount of income that is subject to tax after you subtract your deductions. This is the number that you will use to apply the tax brackets. 4. Apply the tax brackets to your taxable income. This is where the table comes in handy. You have to divide your taxable income into segments that match the income ranges in the table and then multiply each segment by the corresponding tax rate. Then you have to add up the results to get your total tax. This might sound complicated, but it's actually easier than it looks. Let me show you an example. Let's say you are a single filer and your total income for 2023 was $75,000. You decided to take the standard deduction, which was $12,550 for single filers in 2023. This means that your taxable income was $75,000 minus $12,550 equal $62,450. Now let's apply the tax brackets to your taxable income. The first $9,950 of your taxable income falls within the 10% bracket, so you pay 10% of $9,950, which is $995. The next $30,575 of your taxable income falls within the 12% bracket, so you pay 12% of $30,575, which is $3,669. The remaining $21,925 of your taxable income falls within the 22% bracket. So you pay 22% of $21,925, which is $4,823.50. You don't have any income that falls within the higher brackets, so you don't have to worry about them. Your total tax is the sum of the taxes you paid for each segment. So your total tax is $995 plus $3,669 plus $4,823.50 equal $9,487.50. This means that your effective tax rate, which is the percentage of your total income that you pay in taxes, is $9,487.50 divided by $75,000, which is 12.65%. This is lower than the 22% bracket that you fall into because you only pay 22% on a portion of your income, not on everything you earn. Another way to think about this is that only the income that falls within a certain bracket is taxed at that bracket's rate. So in our example, only the $9,475 that falls within the 22% bracket is taxed at 22%. The rest of your income is taxed at lower rates. This system ensures that people who earn more money pay more tax, but not disproportionately more. It also means that earning more money will never result in paying more tax than you earn, which is a common fear among some taxpayers. As you can see, tax brackets are not as scary as they seem. They are just a way of making sure that people who earn more money pay more tax, but not too much more. They also ensure that you never pay more tax than you earn, which is a common myth that some people have. By understanding how tax brackets work, you can better plan your finances and avoid any surprises when you file your tax return. One of the most important concepts to understand about tax brackets is that they are adjusted every year for inflation. This means that the income ranges and the tax rates in the table are not fixed, but change over time to reflect the changes in the cost of living and the purchasing power of money. For example, in 2020, the income range for the 10% bracket for single filers was up to $9,875, but in 2023, it was up to $9,950. This is because the IRS uses a measure called the Chain Consumer Price Index, CPI, to adjust the brackets for inflation every year. The CPI measures the changes in the prices of a basket of goods and services that are typically consumed by Americans, such as food, housing, transportation, healthcare, etc. By adjusting the brackets for inflation, the IRS ensures that taxpayers are not pushed into higher tax brackets just because of inflation, which would reduce their real income and their standard of living. Another important concept to understand about tax brackets is that they may vary depending on your filing status, such as single, married, or head of household. Your filing status is based on your marital status and your dependents, and it affects how much tax you pay and how much deductions you can claim. For example, in 2023, the income range for the 10% bracket for single filers was up to $9,950. But for married filers filing jointly, it was up to $19,900. This is because the IRS allows married couples to combine their incomes and pay tax as a single unit, which gives them a tax advantage over single filers. Similarly, the income range for the 10% bracket for head of household filers was up to $14,200. This is because the IRS allows taxpayers who are unmarried but have dependents, such as children or relatives, to pay tax at a lower rate than single filers, which gives them a tax benefit for supporting their dependents. By varying the brackets depending on the filing status, the IRS recognizes the different financial situations and responsibilities of different taxpayers, and tries to make the tax system more fair and equitable. This system of tax brackets is called a progressive tax system because it makes the tax burden increase as the income increases. In other words, the more you earn, the more you pay, but not proportionally more. This system is designed to make the tax system more fair and progressive by making the rich pay more than the poor and by providing some relief to the low and middle income earners. However, some critics argue that this system is unfair and discourages economic growth by penalizing success and reducing the incentives to work and invest. There are also other factors that affect your tax bill, such as deductions, credits, exemptions, and other sources of income, which can make the tax system more complex and confusing. To get a more accurate estimate of your tax liability, you can use online tax calculators or consult a tax professional. This system ensures that people who earn more money pay more tax, but not disproportionately more. It also means that earning more money will never result in paying more tax than you earn, which is a common fear among some taxpayers. Of course, this is a simplified example that only considers the federal income tax. There are other factors that affect your tax bill, such as state and local taxes, deductions, credits, and other sources of income. To get a more accurate estimate of your tax liability, you can use online tax calculators or consult a tax professional. Congratulations! You have just learned the basics of tax brackets and how they affect your income tax. Now you can plan your finances better and avoid any surprises when you file your tax return. If you enjoyed this video and learned something new, please show your support by hitting the like button and subscribing to my channel. I have more videos on personal finance and taxes that you don't want to miss. You can also check out my playlist on the screen for more topics that interest you. With that said, thank you so much for watching, and I'll see you in the next video.